Good day, ladies and gentlemen. It's my pleasure to welcome you on behalf of TCI Express Limited and SKP Securities to TCI Express Limited's Q4 FY24 and FY24 earnings webinar. We have with us Mr. Chandar Agarwal, Managing Director, along with his colleagues, Mr. Mukti Lal, CFO, and Mr. Hemant Srivastava, COO, Non-Surface Express Business. This webinar is being recorded for compliance reasons, and during the discussion, there may be certain forward-looking statements, which must be viewed in conjunction with the risks that the company faces. I now hand over the webinar to Mr. Agarwal for his opening remarks, which will be followed by a Q&A session. Thank you, and over to you, Chandar.
Good evening, ladies and gentlemen. I welcome you to the Q4 and financial year 24 earnings conference call of TCI Express. Let me start by giving you a brief summary of the economic conditions we encountered during the fourth quarter of financial year 24. Despite challenges in the operational environment during this period, TCI Express demonstrated resilience and adaptability in navigating the market dynamics. We maintained stable gross margins and consistent capacity utilization due to a strong customer base, robust network, and operational efficiency, enabling us to outperform industry peers. Aligned with our shareholder-friendly capital allocation strategy, the Board of Directors has recommended a final dividend of rupees 2 per share. This brings the total dividend financial year 24 to rupees 8 per share, amounting to a significant payout of 400% on the face value, underscoring our commitment to delivering value to our shareholders. Moving on to a brief update on the business developments. The Rail Express has garnered significant interest from customers, and our customer base has grown considerably and over 125 routes to cater to the growing demand. A lot of the air cargo business has also kind of moved towards the rail cargo segment, is what we have noticed. Moreover, I'm pleased to announce the successful implementation of automation at the Pune sorting center. This 1.4 lakh square facility is now equipped with AI-enabled automated cross-belt sorter, enhancing operational efficiency, streamlining sorting processes, and minimizing errors. This advancement has resulted in faster deliveries and reduced inventory holding periods. These efficiency improvements will again firmly establish TCI Express as the innovation leader in the express delivery industry. As we look ahead into the future strategy, our focus remains on investing in technology and automation to boost operational efficiency and deliver exceptional customer service. In financial year 24, we allocated a total capital expenditure of 46 crores towards expanding our branch network, advancing automation initiatives, and fortifying our IT infrastructure. Throughout the fiscal year, we expanded our footprint by establishing 25 new branches, supporting our multimodal express business, and enhancing market reach and customer accessibility. Now, all our surface and non-surface products have their own team, and which will contribute significantly to the top line and bottom line as we proceed. Our strategic investments in technology and infrastructure have significantly ensured that we remain in the forefront of the industry. I'm also happy to announce that our sorting center in Chakan, Pune, has achieved a gold rating in the LEED V4 PED+C warehouses and distribution centers rating system. This achievement underscores our company's dedication and also our approach to sustainability. In the ongoing commitment to people-first approach, we are proud to announce that we have been recertified with Great Place to Work, reaffirming our dedication to fostering a positive and inclusive workplace environment. Also, we are honored to have received prestigious sustainability award from QMI, a leading manufacturer of coated and bonded abrasives in India. We have also been recognized as the best B2B logistics partner for 23-24 by Royal Enfield. These accolades affirm our commitment to excellence and our strong partnership within the industry. Looking ahead, the sector is set for substantial growth. driven by government infrastructure and policy initiatives aimed at enhancing transportation infrastructure, especially at major freight routes, logistics parks, and road and highway connectivity. With this favorable industry outlook, we are confident in our capability to capitalize on the opportunities in the Indian express logistics market and generate long-term value for our stakeholders. With this, I now like to hand over the call to Mr. Mukti to talk about the financial performance of the last quarter. Thank you.
Okay, should I share the PPT?
Yeah, please. Yeah, good evening, everyone. And as this time we are not only doing earning presentation, we are rather giving full presentation to have the feel about the company. That's why we moved on from con call to webinar. And I will be quickly run through this presentation, and then we can have the question answer session. So we, you all aware, we started this company after demerger from TCI 8 years back, and almost we have the 3,000 workforce and 970 branches right now. Yes, next please. So we in this year and continuously we will be focused on offering comprehensive logistics services across multiple domains, including rail, air, international, C2C, and surface express, and tailored to diverse client needs. And we continuously will be focused on asset light model. We will be carrying high value cargo and continuously expansion of services, and we will be continuously focused on automation of our sorting centers. This is our geographical footprint. So we are present across India, which not other companies are. We are west to south and north to east. We are everywhere present, and we are offering all the services: surface, pharma, cold chain, rail, e-com, C2C, and domestic and international air express. So as 2 years back, we established first fully automated center in our Tajnagar center, which is near to Gurgaon. And now second one has also, Mr. Chandra has mentioned, second one we also launched in Pune in March month, and we now streamlining the things. And this is also with the sustainability, where we have the solar in Tajnagar as well as in Pune. Both we have the solar electrifying through solar only. And with that, we have almost we reduced the turnaround time of this cargo almost by 40%. Yeah. So these are the service offering which we started 2 to 3 years back. Rail Express is getting good traction right now. We have the 4,500 customers, and now currently we are operating off 125 routes, and is continuously increasing the numbers of customer and all. And this is again a very customer are very happy with the services, and our target is to be converting air business into rail business with the 1/3 cost. Yeah. Same way, cold chain express, we are only focusing on pharma. We are not going on to other field of food and other related products. So that's why we will be keep the same thought, where we keep ourselves asset light, and we will be hire the assets on outsource model, and we will be keep the same way. Yeah. C2C Express, yes, this is a new niche segment where we creating the business for fast tracking and milk run model, where we collecting the cargo from 2 location and delivering on a 1 location, or vice versa, where we picking from the 1 location delivering 2-3 location. And again, same way will we go with the outsource model, and we will be keep ourselves asset light, so return would be higher, and this is having very huge market, and we converting into gradually in our favor. Yeah. So now move on to Q4 highlights. So we have to achieve a total income of 320 crore rupees. EBITDA is 47 crore, which is EBITDA is percentage margin is around 15%. We announced the final dividend of rupees 2. So totally for the whole year is 8 rupees and 400% on face value. And utilization level of trucks in this time is around 83.5%. Next, please. So this is the financial performance. You can see like we grown in this quarter almost like de-grow by 2.5%, and accordingly PAT is also like lower. In full year basis, we grown on 1%, and at EBITDA level we de-grow like around 3.5%. So same way we have like achieved 46 crore rupees of capex in this year. And in totality, we have added for the full year, we added 25 branches. And in this quarter, we added almost 10 branches, especially focused on our multimodal express business. This is a quarterly performance. We compare like Q4 and then Q3 of last year and Q4 of last year and Q3 of this current year. So you can see the numbers like a margin is in between of like 15 to 17%. PBT margin still in the highest in the industry in the range of 13 to 14%. Yes, please. This is FY24 highlights, and which you seen like we have achieved a revenue of 1261 crore rupees, which is 1% higher, and EBITDA is also 194 crore with a margin of 15.5%. Yeah. And can you go back, Naveenji, slightly, please? So in this year, if you see, we achieved a cash profit of 151 crore rupees in comparison of like 154 crore rupees of last year. So cash profit side, we almost the same what we achieved in the last year. Yes, sir. Next, please. This is the annual performance of last 4 years, where we revenue is increasing trend. EBITDA is also like increasing trend. And PAT margin is again still is the highest in the industry. Yeah. These are the key ratios where our return ratios are in high range, in the range of like 25 to 35% over the period of last 4 years. And cash conversion ratio is again very robust. So we converting almost 70% cash into EBITDA to cash ratio. Leverage, we maintained continuously, like receivable days is hovering from 50 to 55 days continuously. And since 1 decade is also in the same line. Again, payable days we are also having very good, scheduled payment system. So that's why payable days is also in the range of 35 to 38. And accordingly, net working capital cycle is also like 14 to 16 days. We are maintaining that since last 1 decade. This is a balance sheet. We're showing here like balance sheet size has been grown from 735 crore to 850 crore rupees. And if you compare it, so there is no big, difference is there. Like only trade receivable has increased from 211 crore to 231 crore rupees. Assets increased by almost 30. Net assets increased by 35 crore rupees. And rest increase in like whatever surplus fund we have, it is increasing in short-term investment, which grown from 32 crore to 90 crore. So almost 60 crore rupees has gone in there. Same way, if you see on a liability side, everything is added to our, net worth, and trade payables are also same. This is a cash flow, as I mentioned. It is like we have very good, cash flow from operations. This is the we showing the comparison our margin profile with the industry players. So still we are, whether it is EBITDA or EBITDA or PAT, we are the highest one. These are the 9-month results we are comparing, because still few industry players will be launched or giving their results. They are in waiting. So that's why we compare with the 9 months results. So last, 8-year takeaways is like our location has grown from like 32,000 location to 60,000 location, and branch office increased from 500 to 950 plus, and sorting center from 26 to 28. Customer base is also hugely increased from 1.5 lakh customer to 2.25 lakh customers. So that will be, and if you see like EBITDA has been growing in the range of CAGR of 17%. Yeah. So this is a strategic outlook where we will be keep the same way of balance in between of SME and big customers. We will continue focus on metro and tier 1 cities. We will be keep adding new services, which is we like offer, started in 1 or 2 year back. And our planned capex for the last 5 year is 500. Of that, we already incurred around 170 crore rupees in last 2 years. Remaining 330 crore will be spent in next 3 years. Yeah. These are the studies by 2030 where we want like one fourth of the share of multimodal services in overall revenue. Rest we want to be like create a wealth for shareholders accordingly, and we will be continue focusing on asset light business model, and we will be increase the customer base, and we will be keep the shorting center like strategy the same way where we want to be create the big shorting center from lease to own one. Yeah. These are the industry numbers where we are like we have the in market share by volume. Transported by us is around 7%, which is almost like 7% market share. Next, sir. Yeah, next way. So again, government is also like pushing hard this improve the infrastructure continuously, and last year they did like 11 lakh crore plus kind of they carve out the money, capital expenditure for infrastructure development in 24-25. That will be certainly help us to be improve our efficiencies. Yes, sir. These are management team where our chairman, managing director, our next please. Yeah. So sustainability is also like our core pillar, and we are working hard on to be like all the ESG component, environment, social and governance, and we soon will be release our ESG report. First ESG report. You can find it on our website also, please. These are the recent awards we get, as Mr. Chandar has also mentioned, so no need to repeat again, like Pule Shorting Center, then award by the Royal Field and Kyomi, please. Yeah, please. So, yes, please. These are capital market information where we like given a CAGR of since last 8 years we given CAGR of like 14% plus in our share returns. Please. Please. Thank you so much. Now we can have the like question and answer.
Thank you, Mukti.
Yeah, please.
Friends, we now open the floor for the Q&A session. Anyone wishing to ask a question, request you to raise your hand. We'll unmute you and take your question. And friends, if you can introduce yourself with the name of the company or the fund house that you're representing. Wait for a couple of minutes while the questions line up. Okay, we have a question from Alok Devra. Alok, please go ahead.
Yeah, hi. Can you hear me?
Yes, Alok, loud and clear. Please go ahead.
Yeah. So good evening, sir, and this is Alok Devra from Motilal Oswal. So just on the results, firstly, if you could share the volume number for fourth quarter and the full year, and how it was YOY in the fourth quarter.
Mukti, you need to...
Yeah, to start with, so tonnage numbers for this quarter is exactly 258,000 ton, and that is almost like 2% in negative of same year last quarter. And for the full year, we achieved 1 million ton exactly.
Okay. So, yeah. Sir, there is actually, I just wanted to understand, we have, it's been a pretty muted quarter and even a muted year, if you see the full FY24. So what is really happening at the ground level? If you can just give some insights, because the growth has not come through, and we have been, focusing nearly at least a 10 to 15% sort of a volume growth, and we have closed on a flattest number. So how do we see the FY25 panning out and our long-term guidance on the revenues of nearly 2,000 crore? How those numbers stand? Any color on that, please?
Yeah, Chandra, sir.
So I think this is just a temporary phenomena, because we know that at the ground level, consumption has been badly hit because of high prices. And in general, we have seen the consumption taper, especially from the Q3 onwards. Surprisingly, the Diwali, that what we expected wasn't a bumper Diwali at all. So that kind of, influx of, high cost, and even the fact that cash was pulled out of the market. So India being a cash market, I think that also played a very important role in not enabling, growth in the service sector.
Hello.
Yes, Alok, continue, please.
Yeah. Just one last question.
Yeah.
So what kind of growth we are now looking at in FY25, and margins will remain in this range, or could we see some improvement there? That's my last question. Thanks.
We expect about 10 to 12% growth. Also, Q1 is the election quarter, so we have to be very careful about that. And profitability, yes, will be remaining the same, and we will try, of course, our level best to increase it by 100 basis points.
Sure. I will come back in the queue, and thank you and all the best.
Thanks, Alok. We take the next question from Lavina Podros. Lavina, please unmute yourself and go ahead.
Yeah. Hi, Chandan. Hi, Mukti. I'm Lavina from Jefferies. Just wanted to check, see, on this volume angle, right, can you just let us know which industries, if you can give us a broad sense on which industries have seen a decline, because CapEx seems to be picking up, manufacturing is doing well. So exactly which industry has disappointed on the ground, and broadly a volume composition that would really give us some color on what's exactly happening on the ground. Thanks.
Yeah, Chandra sir.
So basically, Lavina, hi, manufacturing has been growing, but consumption has not been. So, I mean, if you look at the pricing that's happening, the major price increase at the ground level, it's not as opposed to, say, the top level or the medium level of the economy, the income level. So it's pertinent to understand that the consumption in, like, say, travel tourism and all that, which has been high, is a factor of several reasons. But if you look at sectors like, even though we are not in that, consumption and even textiles, electronics, all of them have not been growing. So the high price that we are looking at has really made the consumer, not just in India but globally, I'm seeing that the consumption levels have come down. So it's probably a temporary thing, with the high interest rates and the high inflation. It's hopefully this year, as we're expecting that the interest rates should start easing out by September, then things should start getting better.
Also, to add what Chandraji is saying, so basically, I think we also face, already inventories are so high with the, all the showrooms and all the B2B customers. That's the one-off reason. Now, I think once consumption will start, though manufacturing is there, but movement of goods is not there where we are in pitching, where we have to be come into in picture. So that's also one-off reason where dispatches by these manufacturers is less because they already have the inventories there. So that's it.
So, can you give us some industry color? Like, let's say on your volumes, how much is approximately consumption back? How much is in manufacturing back? So that we just get a sense that whenever consumption picks up, what could be the impact for you all on your broad cargo volumes? Just a broad sense.
Yeah, so basically, if you see except auto, all the sectors are not growing in whether it is lifestyle products or pharma. Because after COVID time, pharma still is in flattest growth. They are not growing. Or also I'll mention in a last call where they restricted some to be sending the sample to doctors. that year's not like picked up again because they limited some, sending these goods to doctors for as a sample. So these are the, again, engineering goods item is again not that much growth. They have the very low growth. So these are the, I think, except auto, every sector facing a challenge on, consumption side.
Okay, thank you.
Thanks, Lavina. We take the next question from Ashwini Agarwal. Ashwini, please go ahead.
Yeah, hi. My name is Ashwini Agarwal. I am the founder of Dimitri Advisors. Quick question. I mean, just looking through the pricing and the premium margins that you have versus the industry, is it possible that your growth reflects your premium positioning and competition is kind of capturing the growth because business environment is challenging and people are looking for deals? Are you losing market share? Do you have any proxy for that? How do you maintain your competitiveness on the service side? I understand, but on the pricing side, are you being edged out on growth because of pricing? That's the real question.
So if you see, your concern is right, and you may, but that's not the case actually, because if you see all the industry numbers, 9-month number available, and no one has grown. So this is as mentioned by Chandraji. So basically it is a industry-wise phenomenon where no growth has come. Everybody is facing the challenge on, on revenue side. But if you see price-wise, this industry is really not price hungry, because earlier I also said there is sometime what freight we are charging in comparison to their product values is less than 1%. So they're really not concerned about the pricing. So pricing is not a concern at all. It's the overall economic situation, and customers are like less dispatches are there. That's why it's happening. Once this volume will be back, we will be there. So there's no case at all where we even think for the losing markets there. Our margin is a premium margin, because this is happening because we had a widespread across India presence. Then second is our utilization of vehicle is fantastically high side, because we are getting the business across the India. That's why utilization level is higher. So this is not the way we are losing market share. That is not at all.
And our service levels are top in the industry. So there's no way that I don't think that the pricing is making a difference. It's just that the dispatches from the manufacturing companies are less, and because of less consumption.
So, my follow-on question along the same lines is that, obviously the government has spent a lot of money on augmenting rail capacity in the last 4 or 5 years. Is it possible that the traditional road network is becoming less competitive and rail capacities are taking away some of the share?
I would like to interject. It's actually all the money is going in passenger rail network development, not in cargo or freight. So in the Western world, you have a separate line for cargo and freight. And that is not the case in India.
Okay, so that's not the reason either. Okay, fine. I'll come back in the queue. All the best. Thank you.
Thank you, Ashwini. We'll take the next question from Jainam Shah. Jainam, please go ahead.
Hello. Can you hear me?
Yes, please go ahead.
Yeah, so firstly on the data point part, so if you can share the railways share in the total freight for 4Q as well as full year FY24.
Sorry, can come again? I just missed your question.
Yeah, so what's the proportion of the total freight has been contributed from our railway and other services in fourth quarter and for the full year?
So basically it is hovering around 17.5 to 18% continuously last year. So for the full year is also 17.5 to 18%.
Okay, got it. And sir, if we, of course, this year has been quite muted for us, and if we see the trend for the last 8 years, we have grown substantially at 17-18%. So, what we can see from a 5 to 10 years perspective in terms of growth, along with that, in terms of margin, have we taken any price decrease because of cutting diesel rates or something in the second half of the March, or we are continuing with the same pricing?
Yeah. So again, our strategy would be, like growing 2x of the GDP, except this year was not great and muted for everyone. But next year onwards, we hopefully again come back to that process where we will be growing at 2x of GDP. And on margin side, yes, once we will be come back with the higher volume, certainly our margin will be further improved by 50 basis point, 100 basis point. And again, what the second you asked? Yeah, Jainam.
Jainam, you had a follow-up question.
Yes, so yeah. So after margin, I was asking about the overall growth for like over a longer, medium to longer term. And that is like 2x of GDP, right?
Yeah. And margin certainly we will be improving in time to come once volume will be back. So, otherwise if you see our strength is there in this year also in a low volume, even we maintain our gross margin at the level of 32%, which was the same in last year. So whatever degrowth in slight margin is there due to manpower cost and increase in manpower cost only. Even admin cost is also like same what we had in last year.
Got it. And so this last question was on the pricing part. Have we taken any decrease in the pricing with respect to the rate cut in the diesel price in the second half of the March or something?
No, so basically, if you see, we have the only price hike clause. We don't have any clause which is supposed to be reduced. So wherever price is increasing or decreasing is a positive arbitrage for us, because why I am saying, once price is increasing, then we passing on to everyone, every customer. In all the time, we able to passing on almost 85% customer overall. And then we passing on to our suppliers also, but on their prices, so on my cost. So arbitrage is there. I'm, passing on my price to customer on my prices, means sales price, and I'm passing on to my supplier on my cost price. So that gap is almost obviously is around 30 to 35%. So it's always positive arbitrage. Once prices is decreased, we are not decreasing prices. Exceptionally, 2 or 5 customer or 1 or 2% customer is okay. Otherwise, we are not reducing. Is directly we keep retain with us. We also like reducing the price of our suppliers. So that's why this industry is working, and no need to be like reduce the prices, because again that cut was not a big one. That's hardly they reduce the price by 2.5%.
Got it. And sir, on the one more question from my side.
Jainam, please, Jainam, let's just keep this as the last question because there are a lot of participants waiting.
Okay, thank you.
Please.
Thanks. We'll take the next question from Kripa Shankar. Kripa Shankar, please go ahead.
Hi, good evening, and am I audible?
Yes, you are. Please go ahead.
Yes. Yeah. Thank you for the opportunity. So, quick question. See, just wanted to get a sense around any specific sectors as such, which can, deliver better performance in FY25, which you are having a positive outlook around, and that can be a key growth catalyst with respect to volumes. What are your thoughts around that on the first part?
Yeah, so basically our thrust to be like improve, we hopefully in engineering goods and basically in pharma. These two sectors we are seeing, obviously auto will be continuing to grow. We are not so optimistic about like, this one lifestyle products, or you can say like, textile market, textile products. So we are not so optimistic about that, but otherwise we are hopefully every segment will be increased, every product will be increased. Otherwise we are also focusing on this time on like defense sector and also like in, solar sector, because government is also pushing to be install the solar on like 1 crore houses in this on next years. So we are also focusing that products.
Got it, sir. So now, based on my understanding of the sector, so lifestyle and textile constitutes a big portion of the B2B express industry. Are you not seeing any green shoot at all? Because we are seeing that there are companies which are reporting a relatively better growth in specific pockets at least. Or is it, where is the gap is what I wanted to understand. Is that the growth or wherever TCI Express is present much more, the growth is not happening on those pockets, and that's one of the reasons why we are not able to see that volume growth happening?
So interestingly, we doing the work with only premium brands, whether a name of all big brands. And I think they are not in that shape or in growth. That's the only reason, because pocket, they maybe grow because we don't doing like regional, much transportation for regional level or in intra-state. Basically, we are doing like interstate. So we doing the work majorly for the like big brands. And I think that is still they have some pain.
So if then that is the case, then is it likely that, is there an annual price hike anticipated in the first half of this financial year?
Yes. So we will be, last year as we didn't taken any price hike because there wasn't a muted numbers and volumes are there. So we are not, initiated the process, but this year we are initiating the process again. And hopefully in this year we will be finished with the 1.5% to 2% price hikes in this year.
Got it. Thank you. Thanks a lot. I'll get back in the queue.
Thank you, Kripashankar. We'll take the next question from Dhanan Bagrodia. Dhanan, please go ahead.
Hi, so what were the total volumes for the quarter?
Volumes are like 258,000 ton for this quarter, and for the whole year is 1 million ton.
So sorry, 258,000. So 1 million is total. Okay, so we had volume decline of 2% year on year.
No, so it's not declining. It's almost flat, or I think 0.5% growth over last year.
For the quarter?
Yeah, quarter is yes, -2.
Oh, sure. Thank you.
Thanks, Dhanan. Take the next question from Anshul Agrawal. Anshul, please go ahead.
Hi, thank you for the opportunity, Naveen. Question for Chandraji and Muktiji both. I was reading your comments that we have jettisoned a few customers which are unprofitable in nature. Wanted to understand, are these SME customers, and what would our mix of SME customers be in our revenues currently?
No, so basically these customers which is not profitable one is in a big segment actually, and our customer on SME side is non-profitable one. So that's way.
And what would be our mix, Muktiji, for SME customer mix in our overall revenues currently?
So currently it is around, like this quarter we maintained around again 51, big customer and 49 is a small customer, and for the whole year is again 50-50, because we intentionally don't want to be, get disturbed that balance. So since last 2 decades we maintaining that.
Great. And the remaining capex of 300 odd crores that we intend to spend in the next 2.5 years, could you help us understand which all hubs would we plan to automate and where this capex will get used?
Yeah, so very good question. So as I mentioned already, 2 sorting center already automated. Now in pipeline are like Ahmedabad, Kolkata, Mumbai and Chennai, and then these are the 4 which we are in pipeline. I think in next year we will be start the construction will be start in this year in Ahmedabad or Kolkata, in 2 places.
But the project will get completed only in 26 for Kolkata and Ahmedabad?
Yes.
So these benefits will only come in 26. Would that be correct?
Yes, that is correct.
Despite that, we are saying that we'll see margin expansion in the current year?
Yes, so margin expansion, this is very good thing where we at least started these 2 sorting centers. So at least on lag between Pune to, Gurgaon, we will have some benefit on that, because there is in a both way we have the simultaneous automation. So certainly we will get the benefit in that, what we are earlier estimated. So we will get the benefit here.
Thank you so much.
Yeah. Thank you.
Thanks, Anshul. The next question is from Naisar Parekh. Naisar, please go ahead.
Hi, thank you. Sorry, my question is for Chandarji. So, this year, we can maybe understand, but if you look at the last 5 years, right, pre-COVID to now, we've practically not grown. We were 1,000 crores odd in FY19, and now we are some 1250. Whereas competition has grown significantly. Blue Dart has gone up from 3,200 to 5,200, so 2,000 crore. Safe Express gone from 1,600 to some 3,500, so another 2,000 crore. And delivery has gone up from 1,300 to 5,200 crore, so that's another 4,000. So all of them have kind of grown revenue strongly, whereas over the last 5 years, we are practically flat. So what is the reason for that?
So this is a very good question, Naisar. Basically, if you see, these are the all player in a different mode. Like if you talk about delivery, they are in a completely in a B2C segment, and there is a different one, and they also like doing like FTL. So that's where they are growing very fast, and they also added the new company acquisition there. So talk about like another company, you talk about Blue Dart. So if you see the like last 1 decades, their number was earlier there was in a hugely negative, and then they bounce back gradually. So that's the thing is happening. About the third company, you name it. So I think they more in focusing on third party logistic and full truck load, not in a like majorly into in express cargo. So these are the like within the industry there are different products they are having. So express industry, if you compare us, that is a vis-a-vis like we are there, and then Gati is also there, and then Spot On was there, so Spot On was like now merged with that. So these number, if you see, there's the same kind of number you will be found there. So it is very important to see whether which product we are comparing. So that's the I think I can say.
So you see, over the last 5 years, the market is only higher by 25%. The market that you are in. So that is less than 5% CAGR or 4% CAGR.
Sorry, what you said?
I'm saying you grew from 1,000 crore to 1,250 crore, right? From pre-COVID to right now. Yeah. So my question is that's less than 5% growth. So are you saying that the market that you operate in grows at less than 5% in the last 5 years?
So COVID, we had minus 20% growth. So please factor that in.
No, but I'm comparing pre-COVID to now. So you're saying pre-COVID to now, if we look at CAGR, the market CAGR should be less than 5%.
No, so these 2 years you can't be compared with that. Like 20 is also hit by that, and FY21 is also badly hit by that. And then we grow in 22 and 23. Both year we grow on. So we can't be see like put the same, because these 2 years are just like wastage on that, due to that COVID. So that's the only one reason you can say you can't be take it like CAGR. If you CAGR see like before that, we grown like 15-16% CAGR. So that will be again volume industry. This is a very temporary phenomenon. Once volume will be back, we will be grow again.
And Mr. Parekh, you compared, unorganized segment with the organized segment in Express. So that's not really an apple to apple comparison. If you look at our direct competition, which is listed, you'll see the results are available. You're talking about new age delivery companies. They have their own way of working where they'll take on any business and every business that's possible. But if you look at the B2B business that they're in compared with ours, there's far big difference. So I think getting into minute details is very critical in this industry.
Okay, got it. And second question which I had is from a volume perspective. I think this question was asked earlier, but can you give a split by sectors for yourself? How much is pharma, how much is textiles, etc.?
Yeah, so volume is 55% from these major 5 sectors, which are pharma, electronics, engineering, lifestyle products, and auto. remaining are with other sectors.
Okay.
Yeah.
And for this year, can you mention like which were the top 2-3 sectors that did, like top 2 sectors in growth and bottom 2 sectors in growth?
So basically, growth was in this year is in auto, obviously, and lowest growth in lifestyle products.
Okay. Thank you so much.
Yeah.
Thanks, Naisar. We take the next question from Priyank Chheda. Priyank, please unmute yourself and go ahead.
Yeah, hi. Again, sir, coming back to the aspirations to grow 2x of GDP. And if you see our nominal GDP still growing at double digit, there is overall a buoyancy in the macro environment, except for commodity sectors. Most of the sectors which you mentioned, which contribute large chunk of the revenue have grown. SME credit growth itself is double digit. So what I really want to ask is, what is the introspection that is required from a TCS Express side? Now, what actually is required on the strategic level to change so that we, being such a smaller company in a whole of the large logistics sector, can grow despite all the macro headwinds. So just on a strategic thoughts, Chandraji, if you can help us, it will be great.
So, we have tried lowering the prices earlier to gain market share. And that, I think, is the worst strategy to take on. We can do what other companies are doing. And just take on every kind of business and not worry about the value. The question is then what we had expected from the anvil of GST from 2016, that how the economy will change, how the economy will prosper, took a little bit of shuffling because of GST being coming in 2016, and then elections happening, and then COVID happening, and then elections happening again. So within the 5 years, we have seen that whatever we have created, whatever we are running on, it's geared to withstand all those challenges and still, continue with profitability. Now, the top line growth, what I think you all are concerned about, is something which I keep saying is temporary. It's a temporary halt. It's not something which is like, taken back. The problem would have been if we did not achieve the 15% EBITDA or 16% EBITDA. That would be the concern. There is nothing that we will change. There is nothing that needs to be changed. We have aligned our manpower, our infrastructure in the proper way that can withstand and can go up and down as the economy is going. So, what we need to, as investors, as promoters, we are very patient and we have to understand. And if we take that in stride, we will definitely keep achieving our targets.
Right. So if I have to again circle back, the strategy and the placement of whole of the business construct that is there is rightly placed, and we have to wait for a macro to change in our favor, or customers within the cohort where we are should change in our favor, right? And that, I mean, nothing on a strategic level changes that are required at a TCI Express and that are required.
Nothing at all.
Very clear. Thank you.
Thank you.
Thanks. We take the next question from Akash Vora. Akash, please go ahead.
Thanks for the opportunity. Two details I required. One was, what was the capacity utilization this quarter?
Mukti, you're on mute.
Yeah. This quarter capacity utilization was around 83.5%. Yeah.
Okay.
And for the full year, full year, it is around 84%.
84%. Okay. And how do you expect it going forward?
So once volume will be increased, then certainly we want to be go in the range of 85 to 86% in near term. And in longer term, we want to be in a range of 88 to 89%. Beyond that,
What could be our peak?
Yeah, so that's what I'm saying. So peak would be, we may not be go beyond 90, obviously, then we will be compromised on our service level, which we can't. So that's why we hopefully, in longer term, we want to be 89 to 90 max.
Okay. And sir, could you explain the increase in other expenses this year, this quarter especially?
So basically, CSR amount, CSR and few other items basically.
Okay.
Yeah.
So we don't make a quarterly provision for CSR.
Not really, because this is as and when this is incurring, that's why we are putting the money on accordingly.
Okay. And what would be the amount for CSR this quarter?
For the
for
whole
the year?
For whole year is around 3.5 crore rupees.
3.5 crore. And just last question from mine, sir, was on the price hike. I think in one of the earlier questions you said that you all didn't take any price hikes this year. But I think a quarter or two back, I think you all had mentioned that in a con call itself that you all had taken a 0.5 to 1% kind of a price hike.
In last year, yes, we did. Initially, we taken the price hikes in quarter first. Subsequently, we are not taken the price hike intentionally because continuously flattish volume was there. In this year, we again we will be surely to take the price hikes in the range of 1.5 to 2%.
Okay, so in FY24, there's only one price hike, and how much was that for?
Sorry?
In FY24, we took only one price hike, that was in quarter one.
Yes.
By how much?
It's around 0.5 to 0.75% overall impact.
0.5 to 0.75%.
Yeah.
Thank you, sir.
Thanks, Akash. Friends, anyone wishing to ask a question, please raise your hands. We'll unmute you and take your question. While some questions line up, can we take a few questions that have come on the Q&A board? Okay.
Yeah, please, sir. Why not?
Okay, Kunal Bhatia is asking, please give capex breakup of 46 crores towards branch, machinery, technology, and others.
Yeah, so basically it is going around 25 crore rupees in machineries, which is machineries and other related construction, and remaining around, I think, 15 crore rupees in expansion of branch and other related construction, and 5 crore rupees in technology. You are on mute, Naveen.
Kunal, I hope your question is answered.
Yeah.
Okay, Samayak Jain wanted to understand the correlation of our pricing to customers. Is it directly linked to fuel prices, or we go by market rates, or do we have a pricing advantage for delivering the shipments quicker? Secondly, what is our revenue segmentation in terms of B2B clients versus B2C clients?
Yeah, very good question. So basically, pricing environment here is usually is not like market driven. It is because these are the premium products. So and it is a differentiate on terms of like which customer we serving, like big customer slightly giving less prices, small customer giving slightly higher prices. Different product even have the different segment have the different prices, like pharma have different, auto have the different prices. So that is also varying. But overall, if you see, which I mentioned, sometime what freight we are charging in comparison to the product value is less than 1% or in hovering around 1 and 1.5% max. So that is the case is there. Second part, prices is also linked with the diesel prices. Wherever diesel is increasing, we increasing the prices to customer. Yeah. I hope I mentioned that.
Okay, there was one second part to it. What is our revenue segmentation in terms of B2B and B2C clients?
So almost we have 97% volumes from the B2B segment and only 2.5 to 3% from B2C segment only. Because B2C we are not focusing intentionally. There is no margin since other companies use since building since last 1 decade. That's why whatever business we have as a B2C is really profitable one. and we're doing on a very limited way with the smaller customer, not these big two guys.
Dhanan Bagrodia, he asks, what are the total tons for the quarter?
Total tons for quarter is 258,000 tons.
I think you'd answered, you'd spoken about this.
Yeah.
Okay. Kripa Shankar asks, the KMPs of an have been appointed recently. Notably, there is a new head for e-commerce. Is there any added focus on increased e-commerce to TCI Express's portfolio?
So basically, on e-commerce side, we want to grab the more market on B2B side, where so many people sending the goods to these e-commerce players. So we doing, reverse of that. Like we are not doing B2C, but we're doing B2B for that. So many people sending the goods from like there to these marketplaces. So we focusing, so we should not be like left out with that, market. So we focusing on that from like picking from the small, vendors and then delivering to these guys. So that's market we are focusing on.
Okay. Manjeet Buaria, can you please tell how we compare with key organized players on cost per ton transported? Are we the lowest cost operator?
So if you compare like, 2-3 players, so I think we are in a midway, and we still have the slightly low prices in comparison to our other two competition. New guys is like delivery maybe has slightly less realization than comparison to us.
Okay. Utkarsh Maheshwari, what can be the lead indicator for a pickup, as last year has been a flat year? And another one is also, how does DFCC impact express cargo as a sector? So I'll just repeat the first question. What can be the lead indicator for a pickup, as last year was a flat year?
Yeah, so Chandra sir, you would like to answer on that?
Yes. So the DFCC is not really a threat, because DFCC is built for the commodities and export cargo. So the whole idea was that, from North India to GNPT, it takes about 2 weeks on the road. And on the rail, they want the they want the rail network to take it in a week's time. So that's the whole idea. And commodities also, when they move on trucks, is very, it's not possible, like, to have that efficiency. So, I mean, the benefit would be if, for example, I know it's a far-sighted thought, but imagine in the high-speed rail, whenever that starts in India, we can actually use that. That could be of a benefit, but I highly doubt that will ever happen. It'll only be for passengers.
Thanks, Chandar. Friends, there are a lot of you who are posting questions on the Q&A board. We've kept the webinar. Please go ahead and raise your hand and we'll take it up. Because if you have a two-way interaction, that will be better, I think. But nevertheless, Anshul Agarwal, once again, what would be the differential margins on new services versus existing express business?
Yeah, so basically margin in rail and air slightly higher than surface express always.
Kripa Shankar asks, is there any assessment of what is B2B portion of B2C?
No, so you can separately ask for that. I will be providing the answer wherever more clear.
Kripa Shankar, please feel free to write to us. We'll take it up with the management and get back to you.
Yeah,
Thank you. Next question is from Vinod. Can you indicate the level of customer stickiness in our business? Does a price hike ensure that the customer would stick with us or have a propensity to switch between the suppliers?
So there is two type of customers we have, like SME customer and big customers. So we always, wherever we ask for the price hikes, we ensure they should be stick with us. And as mentioned, they are not really concerned about the cost, because it's hardly 1.5% to their product cost. So SMEs, there is no challenge. And I said we are always able to take the price hikes In the case of like 85% overall basis, 85 to 90%. So few customers, yes, they are rigid. They will not be given any condition. They maybe have the like more pricing power or more muscle power to be negotiate, or they can be threateners to be like switch the business. So that is always there. But yes, we ensuring wherever we ask for the price hikes, it has to be compensated with good service level or like higher volumes, or so that's way is happening. So we always ensuring there should not be like away from us. So I think sorry Navinji, we have to we finish in like 5 minutes. We have another meeting. So
sure. Friends, we have another 3 or 4 questions on the Q&A board, and that's all the time that we have for this evening. What I'll do is I'll share my coordinates on the chat. And if there are any unanswered or follow-up questions, please feel free to write to me. We'll take it up with the management and get back to you. So, Mukti, we'll just take the last few questions on the Q&A.
Please.
CSR 3.5 crores versus last year. Any one-off in other expenses? 20% margins can be achieved at what volumes? And how has been the volume growth till May?
So many multiple questions are.
Okay. Just any one-off in other expenses?
Sorry?
Were there any one-offs in other expenses?
So if you see, Navinji, there's if you see our other expenditures are almost same to last year. Quarter is not important. There's some vary from quarter to quarter. There's not a big issue. So overall year, if you see, that has been in a same level. Like last year we did 72.5 crore. This year we did around 74 crore rupees. So that's almost same.
Okay. The second part was 20. What is the sort of volume that we need to achieve 20% margins?
So, it's very important to know, like earlier we reached to on almost on 70% level. And for 20%, so each year, because this can't be achieved in a single year. So once we trying, supposing we grow in a volume of 15% in next 3 years, we certainly reach touch to like 19 to 20%.
How has been the volume growth till May?
I think it's very, very early to say. As I mentioned, there is an election year. So many rallies are going on, politicians coming. So this is disrupting the all logistics. So it will be, I think, flattish for what we have in like quarter 4, same way.
Okay, Saurabh.
Even we told in last, after in Q3, con call, we said that same way. And this is the same way is running. This is the election time, so we can't commit anything.
The board of directors has approved investment of additional equity for an amount not exceeding SGD 1.5 million in the wholly owned subsidiary TCI Express PT. Request to please share more information on the investment into this subsidiary.
So I think we will be then can separately answer for that. It's long answer basically.
Saurabh, you can send us a request. We'll try to connect you with the management, or you can drop me a mail and we'll get back. Thanks. Jainam Shah, the last question. As management has been commenting about stocking and not much deliveries, are we planning to expand into warehousing? Isn't it a big opportunity for us?
Really, we will not be going into that sector. We're very clear about that. And we will not be going that sector at all. We will keep stick our express industry only.
Okay. The final one. Manjeet Buaria actually is follow-up. I was checking cost per ton for us, not realization per ton, we charge our clients. So it's basically asking what is the cost per ton for us?
What the cost for us?
Yeah.
So basically, if you see, my gross margin is like 32%. So you can imagine is the 68% is cost. So you can be like divide on that. So simply, it is like, 6.80 kg because it's a 1 million, sorry. So I need to see that. It's around, I think, 8.5 rupees. It's a 68% of revenue. So you can directly divide on that.
Friend, we'll have to wind up out here. Thank you very much for all those questions. I've shared my email ID, so please feel free to write to me. I'd like to hand over the webinar now to Chandar for his closing remarks. Chandar, please.
Thank you everyone for joining us today. We have tried to address all your questions, and if you have further inquiries, please connect with our investor relations team, and we will be happy to address the same. We look forward to meeting you in the next quarter. Please stay safe and healthy. Thank you once again, and thank you, Naveen.
On behalf of all of us at SKP Securities, I'd like to thank Mr. Agarwal, Mr. Muktilal, and Mr. Srivastava for joining us and taking all the questions from the investors. And we look forward to hosting you again for the next quarterly results. Thank you and have a wonderful evening. Bye-bye.
Thank you.
Thanks a lot, please.